All right, it's Tuesday, and we got our inflation data in. That's Canada's inflation data for September. It came in at 2.4%, which is roughly what the expectation was for inflation. Does that mean the Bank of Canada is not going to cut interest rates at the end of this month because this number is above target? Nope. They're more than likely going to move forward with a cut because of the economy that we are in right now. We are bleeding jobs everywhere. Here's just one example of Molson Coors eliminating about 9% of their workforce. We have some banks who have been doing some restructuring. We also have Stellantis that is moving their plant out of the province, causing more job losses there. We also have oil still dropping under 60 bucks a barrel. Now, one of the reasons why inflation was at 2.4% was oil in September was a little bit higher than it was previously. So that is one of the reasons why. But we've had a decrease down past 60 bucks a barrel. So that's going to affect October's inflation data when that comes out next month. And of course, even with this news of higher than expected inflation, even though pretty much in line, the yields barely even reacted to it. More than likely because they think what I think. The Bank of Canada is going to be cutting interest rates again this month. They have to start rescuing the economy. And as we all know, recessions, if you follow me, you know, recessions are naturally deflationary. People don't make enough money to keep prices high. So there's definitely deflationary pressure on the whole basket of goods in the inflation data. And also, the Bank of Canada has been making a bit of a pivot away from talking about inflation as one of their main metrics and going more towards economic stability and employment. So we have that as well. More than likely because they figured these numbers will be high. Now, why did they figure these numbers would be higher than being at target? Because of mortgage interest costs being high. And that mortgage interest cost number is going to continue to be high as more and more of those COVID mortgages renew, which basically that was 5 years ago. A lot of those low interest rates are now renewing to higher interest rates today. So those mortgage interest costs are going to keep inflation a little bit high as well. The Bank of Canada knows this.